Hey everyone, Coach Investor back on our video for today. So as promised, here's a longer version of my opinion on Enphase right now. Now, for those that don't know what Enphase is, basically Enphase provides semiconductor-based microinverters. These convert energy from DC to AC at the individual module level and are easily installed at the same time as panels. Now, microinverters are especially attractive in residential settings where regular maintenance may be sparse and shading is often a problem. Now, with regards to the markets that they're playing in, so solar panel market projected to grow at CAGR of 18% by 2030. This is driven by increasing demand for renewable energy sources and government initiatives. By the way, solar panels, the price for it has been coming down heavily for years now, which makes it extremely affordable. But the problem here is the grid. The problem is storage. As we've seen with Tesla, for example, the problem is building more and more storage at scale. You need more batteries, etc., etc. That side of things still takes a lot of time. Now, with regards to the global microinverter market, that size is expected to reach $7.4 billion by 2028, rising at a market growth of 17.8% CAGR during that period. And so it's safe to say that the market that Enphase is playing in right now has a lot going for it. There are a lot of tailwinds, but in the short term, yes, we do expect some headwinds, especially because of the high interest rates. Now, currently, this is the picture that you get from Enphase, right? If you look at the stock's performance, the last year it's down 53%, year to date it's down close to 50% as well. But if you look at the big picture, right? The big picture looks quite nice, no? Revenue has been increasing throughout the years, free cash flow positive as well. Return on equity is pretty good. Then if you look at gross profit margin, yes, it has been higher before, but currently with the headwinds, it is still at a nice area here, 45% or so. P to growth ratio in the next 12 months, 1.15, so definitely not on the expensive side. If you look at forward PE here, 25.6 times, in my opinion, for a company like this, is not that expensive. That said, we're going to look at the graph later in this video where you will see that you might get another 10% drop or so if you look at technical analysis and stuff like that. But if we look at the analyst forecast, right, for 2023, they expect sales to grow at around 14%, EPS close to 10%. Now, 2024, things get much better. Sales growth, 23%, EPS growth close to 33% as well. Same thing here for fiscal year 2025, sales growth of around 27.3% and EPS growth of around 30%. So yes, right now, again, you have some short-term issues, but the long-term story here is still quite good in my opinion. And so what exactly has happened, right? Why was guidance so bad? Why did the market react the way it did? So they gave us some more color during the earnings call. So I'd like to provide some more context about our revenue guidance for Q3. Our microinverter sell-through in the United States peaked in the fourth quarter of 2022. The sell-through in the first half of 2023 in both Q1 and Q2 was approximately 20% below the fourth quarter due to high interest rate environment in the United States. Our selling to the channel was only 10% down in the first half of 2023 relative to the fourth quarter. We were expecting a seasonally up Q2, but that didn't materialize. This has increased the inventory in the channel. By the way, Q2, the guidance there was already lower than what the analyst market was expecting. Then with regards to market share, because some people might say, oh, they're losing market share, it's not just interest rates. Well, with regards to market share, we see stable high market share today for microinverters based on both internal and third-party data. Competition is not new for us, and we have always relied on our differentiated technology with distributed architecture, product quality, and customer service to win share, and we expect to continue doing so. We have many tools that are at disposal for installers, and our partnerships go even deeper during the downturn. And I agree, most good companies during a downturn perform much better coming out of a downturn because they have the possibility of maybe helping their partners, their installers in this case, helping them out during a downturn by lowering prices, being extremely close to them when it comes to installing, new partnerships, etc., etc. And so you gain even more trust. The relationship becomes better and better. And so when times become much better, that partnership grows and becomes bigger and better as well. And then you can maybe have more partnerships because, well, word of mouth. Look, this was my experience when things were bad. Now things are better. I think you should go with them, etc., etc. Oh, and by the way, this was the United States. In Europe and Australia, the growth there is quite good, so expect maybe even more growth internationally. Now, before I continue, if you enjoy this type of videos, leave it a thumbs up, subscribe. If you have not, we're trying to reach 30,000 subscribers by the end of the year, so thank you very much. If you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. And by the way, if you're not following me on X, previously Twitter, please do so. Link is down in the description as well. We're over 8,000 followers there. So again, thank you everyone that has been supporting me lately. I really appreciate that. Now, when it comes to supply chain and the positioning of that company and their growth expectations there, so they're saying here for microinverters, currently they have 6 manufacturing sites with capacity at 8.75 million micros per quarter. Now, leveraging the Inflation Reduction Act, which by the way is another tailwind for this business, to bring high-tech manufacturing and jobs to the United States, a bit like Intel, TSMC, etc., etc. They plan to exit 2023 with a capacity at 10 million micros a quarter, and so they'll be well prepared when the market turns. When interest rates come down and suddenly demand ramps up, they'll be ready for that. Now, when it comes to batteries, currently 2 cell pack suppliers over 1 gigawatt hour a year. Globalization efforts on batteries are underway, not just for them, but for many other players as well. Again, batteries are key here. Then when it comes to the Enphase energy system, so it's really like an ecosystem. So you get the Enphase cloud, the IQ microinverter, the EV charger, by the way, the bi-directional one, so you get to charge your car, and the opposite as well. Main load center, IQ load controller, the IQ battery, the system controller, heat pumps, utility meter, and IQ combiner. All of that is one big package deal, which is going to be extremely important because you want to lock people into your ecosystem, a bit like what Apple has been doing for years and years. And I believe Enphase could be doing so as well. Tesla will be doing so as well with their energy side of the business. And now let's touch on this slide right here. So increasing their share of wallet per home. So in 2019, all they had to offer here is the IQ7, so the family of microinverters, just $2,000 potential per home. Then 2 years later, 2021, they added the IQ battery. They also increased the price for the IQ7 here. So total Enphase potential per home, $9,000. So a huge increase by $7,000. And then 2022 and more, so the IQ8, then IQ battery, load controller, EV charger, fuel cell, etc., etc. So the potential here is increasing yet again by $3,000, reaching $12,000 per home. Now, the problem with this, of course, this is very positive, right? You increase the value per home. It's a bit of the equivalent of increasing ARPU, right? Average revenue per user. But in this case, it's a potential per home, $12,000. But my question here is, does it stop there? Is this the peak? Is this the ceiling? $12,000 per home and we're done there? Probably not, but in the short term, probably yes. But still, there's huge demand for this. Despite the recent popularity of being self-sustainable, etc., the demand is still there. The market is just being tapped in right now. It will continue to grow and grow. And so staying at $12,000 for the next coming years is not such a bad thing. Then in the future, they can probably add more and more products, more software services, etc., that will also increase the margins. Now, last 2 things here. One is the share buyback, right? The $1 billion in share buyback. This also shows that the company thinks that maybe their shares might be undervalued currently, or maybe if the price drops even further, they will be buying back shares. Of course, they can do so because they are free cash flow positive for a while now and generating cash each and every quarter. This just proves that the management is confident in their business, and if the stock market punishes its stock, they will more likely than not buy more shares. Now, when will that happen? Because if you look at the graph right here, right, the stock since its peak has been crashing down quite a lot. It's still in a downtrend. So again, you can dollar cost average if you're in it already for a while. For those that want to open a position, still open maybe a tiny position, never go all in at once. Now I drew this line here, which is around $120 or so, because previously back in 2021 and 2022, January there, it was a support line. So again, you could wait. It's another 10-11% drop or so. Or if you think, look, the business right now, valuation right now, looks pretty good to me. So I'll open a tiny position, and then if it drops more, I'll just dollar cost average. I know some people are saying this will go below $100 or so. The $100 mark is always a psychological barrier, whether it's support or resistance. So a lot of people are focusing on $100. But here, purely on a technical basis, yes, 120 was previously a support. Let's wait and see what happens this time. But currently, it is still in a downtrend. RSI is pretty low, not oversold on a weekly basis. MACD is now again bearish. So invest accordingly, slowly but surely. All in all, you're going to buy a good business for the long term. Yes, short term, there will be some pain. Maybe next quarter will be a miss. Who knows? But for the long term, this company is extremely well positioned. And so do share your thoughts down in the comments below. What do you think about Enphase? Do you hold? Have you sold? Let me know down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.